This is our first chance, Chris, I believe, of having a proper mafia in Australia. And when I say mafia, I think the original one was called like the PayPal Mafia over in Silicon Valley. And these mafias play an outsized role in deepening a tech ecosystem. When you have a bunch of early employees who get a bunch of cash from working at one of the biggest startups in the space, you get these folks who are now what's sometimes called post-economic, right? They don't need to work for a living anymore. And they've also gained the experience of working at Canva, which is a real, proper Silicon Valley style tech company.
You're listening to the Startup Podcast. This is an educational episode, in-depth masterclasses about the concepts essential to building, running, and investing in Silicon Valley-style startups. Whether you're a founder, investor, or operator in a startup, you'll gain insights into the principles that power high-growth disruption, the same way Facebook, Google, and Uber do it. The conversation starts now.
Hey, I'm Chris Saad.
And I'm Yaniv Bernstein. And welcome to this special bonus episode of the Startup Podcast. When we put the call out for listener Q&A, we actually got a couple of questions that are quite specific to the Australian ecosystem. Now, we have listeners all over the world, so we didn't want to put them in the main episode. Instead, we have a bonus episode for Aussies, and I guess the Aussie curious, with a couple of Australian-specific Q&A questions about safes and about the future of the Australian startup ecosystem. So stay tuned for those questions in today's special bonus episode of the Startup Podcast. This episode of the Startup Podcast is brought to you by Vanta. You might know that sinking feeling. You're about to land a big contract when they ask about compliance. SOC 2, ISO, PCI, Essential 8. You've just snatched defeat from the jaws of victory. Not anymore. Vanta massively accelerates your compliance efforts and allows you to get those life-changing deals back on track. Don't wait until it's panic stations, though. Get started with Vanta today. They're offering 20% off their prices just for TSP listeners. Do yourself a favor, hit pause, go to vanta.com/TSP, that's VANTA.com, to get that 20% off. The first question for our special bonus Aussie Q&A episode comes from Franco Ali in Sydney. And Franco asks, what's the realistic ceiling for the Australian tech startup sector for the next 10 years look like?
I'm sure, Yaniv, you might have more numbers at your fingertips and more realistic bottom-up analysis of how big the market is and how big the venture capital is and all this kind of stuff, grounded and principled. But just philosophically, I don't think there should be a ceiling. I think if the culture and the community sets their sights and their ambitions on global disruption, rides the AI wave, raises capital from smart money, both inside and outside the country, and builds the kind of venture-backed Silicon Valley-style startup that we talk about on this show, I think the ceiling should be infinite. Now, the reality is that's not going to happen. There'll be a lot of cultural malaise to dig through and a lot of dumb money floating around and distraction and what have you. But that would be my ambition for the sector. But Yaniv, I'm sure you've got a more realistic answer.
Yeah, I'd approach this less in terms of numbers, but I'm cautiously optimistic. I think, Chris, you and I started this podcast in part because of a certain level of frustration with how the startup scene operates here in Australia. And first of all, I'd say we have a lot of advantages. If anything, I'd say we're overweight, a punch above our weight in terms of the availability of capital, right? And I think there are reasons for that. We have some of these big VCs and they draw their main limited partners, their investors, are superannuation funds. So this is actually a little hidden truth, which is kind of cool, which is that our superannuation system, which is per capita the largest private pension fund in the world, actually provides this pool of capital that in part is funding our VC industry. So I think we're well funded, right? What has been frustrated is sometimes the conservatism of some of the investors and also the lack of experience, the lack of knowing the game that we're all playing, right? Both as investors and as founders and as operators. And that was kind of the impetus behind the Startup Podcast initially, right? And I think that's slowly evolving. I still see a lot of that conservatism and lack of knowing the game, which does frustrate me. But, we'd have to say that we have two massive success stories in Australia, right? The first was Atlassian. The second is Canva. And Canva is the one that interests me. So Atlassian, an incredible story, but also kind of from an earlier generation. It was before there was widespread employee equity for companies in Australia. So most of the wealth has accrued to the founders who are spending a lot of it on property, but also a lot of it on cool stuff. They have their own funds, but they're more impact focused. Now, the really interesting thing that's happening now is Canva, which is one of the top 10 most valuable private companies in the world at the moment. This is actually hot off the press. They've just finished a massive, I believe it's $1.6 billion secondary round. What does a secondary round mean? It means they're not raising capital for the company. It means they've allowed the existing shareholders to sell their shares to someone else. So it's actually a liquidity event, a $1.6 billion liquidity event into the Australian ecosystem. A lot of that goes to employees. A lot of that goes to early angel investors and so on. And so this does a couple of things. This is our first chance, Chris, I believe, of having a proper mafia in Australia. And when I say mafia, this is, I think the original one was called like the PayPal Mafia over in Silicon Valley. And these mafias play an outsized role in deepening a tech ecosystem, because what you do when you have a bunch of early employees who get a bunch of cash from working at one of the biggest startups in the space is you get these folks who are now what's sometimes called post-economic, right? They don't need to work for a living anymore. And they've also gained the experience of working at Canva, which is a real proper Silicon Valley style tech company. These people can now do two things, right? One is they can leave Canva and go off and start their own startup with the confidence and the backing of not having to work, of having that capital behind them, and also the network and experience they have from working at Canva. So these startups are going to be, in my view, more likely to be successful, more likely to be ambitious because of the culture they've come from. The second thing is, even if they don't go off and start their own thing, they will become, a lot of these folks, if they've made a couple of $1 million from these secondary sales, they'll become angel investors. Some proportion of that capital will be allocated to angel investing. And many of these folks will be smart money angel investors. They will be high quality angel investors who are actually looking to fund that next wave of Canva level ambition in Australia. So I actually think this is super exciting. I think it could, over the next few years, really raise that ceiling on what's happening in the Australian tech and startup sector. And Franco, as Yogi Berra was quoted as saying, predictions are hard, especially about the future. I'm not going to put numbers around this. I don't know exactly what the ceiling will be, but I would say, and maybe this is hype, but I would say the Canva secondaries is the biggest and most underreported story in terms of the future health of the Australian tech ecosystem of the past few years.
Yeah, absolutely. And these large exits with employee equity are at the heart of the flywheel that makes Silicon Valley hard to replicate.
Yep.
It's kind of like a star factory, right? Like these nurseries that you see in the universe that are producing stars, and those stars are exploding and they're producing yet more stars. And this is just priceless reinjection of capital and momentum into the ecosystem. And you can't fake it. You can't fund it through government enterprise. You just have to let these cycles play out.
Yeah.
And you mentioned capital, and the capital will get re-injected through these employees becoming post-economic, as you said. You also have to add to that the operational experience. Mm-hmm. So not only are these guys cashed up, they have the operational experience of Canva. So when they go and become founders, they know what it takes to hustle and execute as Canva level operators. Or when they go join other startups, they're Canva level operators. Or when they invest, they're looking for, as you said, Canva level ambition and operations. And so, the capital is, let's say, 50% of it, but the operational excellence is, I would say, at least 50% of it. So that is very, very exciting. Yeah. So yeah, we're starting to see our little flywheel sputter and churn.
I've been previously on the record as being slightly disappointed at the lack of a really powerful Atlassian Mafia. There are definitely some good startups that are from ex-Atlassian folks. But like I said, and this is not the fault of the founders, this is actually a sign of how far certain things have come. I think the Australian tax code was actually changed to allow employee stock options to be tax effective. When Atlassian was founded, that wasn't the case. And so I think the fact that, there are a lot of great folks at Atlassian, but they didn't have that sort of broad injection of capital that allowed it to become a star factory. I think it was a bit less of one. I'm a lot more bullish on Canva just because of that reason, because of the timing. And well, let's see. But I think these things, they carry a whole generation of startups, right? Like if you look at Silicon Valley, you've got PayPal, Google, Facebook. Those are probably the three big star factories of the last 3 decades. But there are other ones. Like again, Silicon Valley is bigger and broader and richer. And, obviously, Chris, there are Uber mafias and,
I just saw an article about what the Uber Mafia has achieved recently, and it's mind-boggling.
I believe Canva is the first Silicon Valley scale mafia, and we're about to see it kick off, and I cannot wait.
Yeah, and just to put a very fine point on this, right? So the PayPal Mafia, which is the first former executives at a major successful tech startup that kind of got called a mafia because they all went off and did stuff that was really interesting and valuable. Just to put the very fine point on this, we're talking about, from PayPal, Peter Thiel, who is the first money into Facebook and Palantir and Founders Fund, which is a very, very successful fund. We're talking about Elon Musk, who...
Never heard of him.
Obviously, SpaceX, Tesla. Never heard of him. We're talking about Reid Hoffman, right, who founded LinkedIn and is one of the major partners at Greylock. We're talking about David Sachs, if you like, all in, and even Dave McClure, who did 500 startups to a degree. So these guys are behind many of the household names that you know. So PayPal is the star factory, the seller nursery that gave a lot of beautiful solar systems to the universe. And this is repeated over and over again from Facebook to Uber to you name it. And so Canva is hopefully going to join those ranks if those executives and employees behave and think the same way. And I think they will. Okay, Marcus from Townsville asks, are safes, he's talking about an investment mechanism, capital SAFE.
Simple agreement for future equity.
That's what it stands for. Are they as common in Australia as the US? I'm preparing myself to start a pre-seed fundraising process, and I prefer to use the structure of a SAFE versus a priced round, but I can't find much info online of any big firms in Australia, VC firms in Australia using these. Thanks, and obviously love the show.
Oh, thanks, Marcus. Okay, so again, I don't have statistics to hand. Are safes as common in Australia as the USA? Maybe, maybe not. What I can say is they are actually very common, and I would say standard for a pre-seed round. Safes offer a bunch of advantages to founders in the sense that, the S, like I said, stands for simple. You don't have to have a shareholders agreement. You don't have to do all the proper full cap table management, stuff like that. They also have some advantages for investors that tend to offer stronger dilution protection than a price round and that sort of stuff. And so they are very common. You said you can't find much info online or if any of the big VC firms in Australia use these. So what I can tell you is that Airtree actually maintain a safe template in the same way that the original safe template came from Y Combinator. They invented the instrument. In Australia, Airtree have a safe. You can download it for free. You can edit it. And so they're very common and they're very widely accepted. There is one wrinkle, again, that's in the Australian context that I've seen some angel investors use as an objection, I think validly, is in Australia, there's actually a tax benefit for what's called ESIC, which is, I think, early stage innovation companies. If you invest in an ESIC, then you get a bunch of tax benefits as an investor. But those benefits only accrue if you're actually buying shares, not if you're investing in a safe. And so some angel investors will only invest in ESICs, some won't. But certainly, safes are common, they're standard. I've invested in numerous Australian companies on safes. So I would say, go to Airtree and go for it.
And just a little bit of clarification, just so that our audience gets as sophisticated as possible. We're really talking about priced rounds where the investor is buying equity versus unpriced notes and unpriced rounds where they're giving you capital for basically what's called a promissory note, a promise that you will give them equity later at a valuation TBD or to be determined. A safe is a kind of unpriced round. It's just a specific set of paperwork and template. So a safe is a template for executing an unpriced round on a promissory note. As you said, Yaniv, and just to reinforce, these are more common with angels and more common with very early stage investments. So VCs that are doing a traditional seed, late seed, Series A, Series B are not generally looking at doing unpriced rounds on safes. And then finally, you mentioned the ESIC. I just want to point out that's one of those unintended consequences of government intervention, right? Because safes and unpriced rounds might be better for founders in the early stages, but by nature of the regulation, the tax benefits, you have investors making a choice based on regulation instead of based on what's better for the company. And so I just want to always caution the government policymakers to just be more cautious about this stuff, and founders and investors be more cautious about letting regulatory frameworks dictate your behavior, which may be counter to the needs of the startup.
Yeah. Okay, two things. So first of all, just to address that last one, this is less about regulatory framework. This is tax code. Like every country in the world struggles with tax codes introducing distortions. Like why do companies issue stock options rather than RSUs in most cases? Because of the tax code. That's true in Australia, it's true in the US. So these things happen. But I just want to talk quickly about the term unpriced because I think it's technically correct, right? Like a safe is technically unpriced, but nearly every safe includes a cap, which is effectively a price.
Yeah, but it's a maximum price.
So what you're actually doing is agreeing on a price, but providing dilution protection to the investor.
But this is important because a lot of people are using safes and unpriced rounds with a low cap, which effectively prices the round. And that's actually problematic. The idea should be that the cap is large enough that you're unlikely to hit it, but small enough that it doesn't dilute you to hell. And so that's actually worth discussing is these caps are not supposed to be pseudo valuations. They're supposed to be maximum valuations to protect against dilution.
Let me disagree with you. In practice, maybe that's what they're supposed to be. In practice, that's why I brought up this issue. I don't believe most safes are unpriced rounds. I believe the cap is the valuation. That's how it is treated by investors. That is how it is treated by founders. And so what you're really doing is you're saying there's a price, but we can make it a bit higher. Like it makes it a bit easier for the investor to get on board because they're like, oh, okay, if when the formal price round happens, the valuation's lower than that, I get the dilution protection. But you don't see pre-seed safe on a $30 million cap. You see it on a $4 million cap because that's actually kind of the valuation, right?
You do in Silicon Valley.
Okay, folks, that was another action-packed episode of the Startup Podcast. But if you've been listening for more than 1 or 2 episodes, you know this podcast is not free. We have the pact. In return for all the hard work that we put into making this show and providing you value, we ask you to do a couple of very small things, and that's all we'll ever ask of you. We would like you to please follow us in your listening app, rate and review us as well, subscribe to us on YouTube, and give us a shout out on LinkedIn or wherever it is that you have your audience of founders. Now, this is not an enforceable pact, right? This is about looking inside yourself and saying, am I the sort of person who honors a pact? Of course I am. I'm an honorable person. So stop that guilty feeling nagging in the back of your head, thinking, really, I should get onto that pact. Stop what you're doing right now, hit pause, and go do those couple of simple things, and then you can ignore this from now on. Okay, Chris, that was a great episode. See you in the next one. This episode of the Startup Podcast was brought to you by Vanta. Vanta helps businesses get and stay compliant by automating up to 90% of the work for the most in-demand compliance frameworks. With over 200 integrations, you can easily monitor and secure the tools your business relies on. Head to vanta.com/TSP for 20% off their incredible offering and start unlocking extra revenue today.